The internet's a great place if you're looking for information. If you ever tried looking for a workout routine, there are thousands of options out there, but the easy answer is just getting out and doing the thing is going to build the most success. And when it comes to investing, it's the same way. You can look on the internet and find ways of trading Forex, options, crypto to try to build wealth, but I wanted to share a strategy that I've been using for the past 2 years that I think is the best ways for normal people to build wealth. It doesn't take a lot of effort. Once you get it set up, it kind of runs automatically, and the whole focus behind it is that it's simple to do and it is customizable for any different type of investor. So today we're going to be talking about the dividend snowball effect, a strategy that I've been using for 2 years to build wealth, and explain how to set it up, some of the important things to remember, and why I think it is so effective at building wealth for people with low to moderate incomes with not that much effort required. In this video, I wanted to talk about a couple main topics. The first one is we have to talk about what a dividend is. It is the whole basis of this investing strategy, and for people that aren't as familiar with it, it's a good reminder of how this works. If you want to skip past it, I'll put up a timestamp right now if you want to skip to the nitty-gritty of what we're doing today. Part 2, we're going to talk about what the dividend snowball strategy is, some of the important things to remember and why it's different than other strategies and the flexibility that goes along with it. Part 3, we're going to talk about how I pick stocks, because the strategy is just kind of the outline of how to build wealth, but you have to actually go in and buy stocks. And I want to talk about my 4 rules that I use to buy some of the best dividend stocks out there that make it so that it lowers a lot of the emotional commitment required to buy into different stocks and lowers the overall risk of my portfolio. And if I'm going to talk about this strategy, I might as well show you exactly what I'm doing. So in part 4, I'm going to show every stock that I own in my dividend snowball portfolio and kind of explain the thought process behind them. And then in part 5, we're going to talk about taxes and some important things to remember before you start implementing the strategy on your portfolio. If you made this far, please hit that like and subscribe button. I'm trying to push as much dividend investing content out there, and it really helps kind of motivate me to make more content. So be sure to hit that like and subscribe button. So part 1, we have to talk about what a dividend is, because it's the backbone of this strategy. For people that don't know, when a company makes money with their net income, they have a couple of different things that they can do with it. Number 1, they can hold on to it for cash on hand. This is something that can be used for a rainy day. It can be used to, expand the business in the future. You have companies like Apple that have historically held on to more cash than pretty much most companies are worth at this point. At one point, they're holding $55 billion worth of cash on hand, and it's something that protects them for the long term. They can also use it for research and development, which allows them to put out future products that allows them to have extended success, because what works now may not work 5, 10, 15 years in the future. So you have to come up with new products, and that's an area where you can throw that cash, or you can put it out to the shareholders in the form of a dividend. A dividend is a cash amount that's usually paid out quarterly, annually, biannually. It really depends on what's going on, but it's seen as a reward for investing into the stock. If you look at the overall stock market, dividend stocks are a lot more rare than they used to. When you have all this money coming into companies, nowadays with technology companies, if you look at them, most of them do not pay a dividend because the investors want them to reinvest that money into research and development to put out these groundbreaking technologies because of how quickly their markets and sectors change. So you need to be on top of things. When you look at some of the more established companies out there that have been around for a long time, when they started putting out dividends, it was a very common practice. It is viewed as a reward of investors for holding the stock for the long term. For the basics of investing, the stock price is determined based off of the flow of buying and selling of shares. So as a reward and an incentive for people to hold on to their shares, these companies incentivize that by paying out a cash dividend for people that hold the shares over a certain amount of time, also called an ex-dividend date. So if you hold the shares past that date, you get paid out that dividend. So when dividends are paid out, it is a proportion of their net income or earnings per share that are paid out to the shareholder. Some important numbers that you need to look at when it comes to dividends is the dividend yield. This is easily just the amount of annual dividends. So if it's paid quarterly, you multiply it by 4 over the current price. And so you're gonna have a variety of dividend yields out there that kind of shows how attractive a dividend is for a long-term investor. It's gonna be a variety of numbers from 0.1% for companies that don't pay a lot of a dividend, or it can go all the way up to 10, 15%. But there's kind of a sweet spot in the middle. The thing that I'm looking for, the number that is too high for me, is anything above 5% is a risk, and we're going to talk about at the end when it comes to risks that go along with the strategy. The next important number to pay attention to is the dividend payout ratio. It's the ratio of the earnings paid out over the amount of earnings. So the closer this number gets to 100%, it means that all of the income is getting paid out to the shareholders. This is important because the higher it gets, the more in danger that dividend is. And we'll talk about that later when it comes to dividend cuts. But the lower the dividend payout ratio is, the healthier the dividend is going to be. It means that the company is able to pay out that dividend successfully for the future, and that is something we're really kind of focusing in on, is the health of the dividend, because we're looking for investing for the long term, not just them to pay out the dividend the next quarter. We want them to continue to do that and have the ability to raise that dividend into the future. All right, so now we're going to talk about what the dividend snowball effect is and what the strategy kind of entails. We talked about what a dividend is, and this whole strategy is based behind buying the best dividend stocks out there. You can do this with any dividend stock out there, but I like to diversify my portfolio with five to 10 different stocks because it gives me a variety of ways to make money. So the dividend snowball, think of standing at the top of a hill. You have a lot of potential energy for my physics nerds out there. It means that being at the top of the hill, there's a lot of potential, because the further up you are, the more time and acceleration your whatever object you throw can have. So for us as investors, the thing that's going to accelerate us the most is going to be time. So when you're at the top of this hill and you push the rock, when it starts going, it's going to go relatively slow. Think about this as if you start a portfolio right now, you may be getting $10 of dividends a year, 15, 20, which really doesn't sound like a lot, but when you fast forward 20, 30 years in the future, that can be thousands of dividends in dollars per month. So it really adds up over time, but at the beginning, it's going to feel very slow, and the longer you have, the faster it's going to grow, and that's the snowball effect. Is the further down the hill it goes, and the further in the future we look, the more dividends you're going to have, and it allows the process to accelerate faster. How does it accelerate faster? Is because you are constantly adding more money to the portfolio. One of the huge parts of this strategy is dividend reinvesting and continuing to dollar cost average. Dollar cost averaging is the process of, on a regular time basis, buying into the stocks in the overall market. So this isn't trying to time the market. This is saying, hey, I'm going to invest $100 on the first Monday of every month and just buying into the market. This is making sure that we are continually throwing money in there, which goes along with the dividends are getting paid out. The essential part of this is dividend reinvesting. So the percentage that the stock pays out is the dividend yield, and that allows us to buy additional shares of these companies. So if you have a 4% yield and you're able, say a stock price is $100, that means you're able to buy 4 shares of a company just for free for holding those shares. So over time, it allows you to build up a massive portfolio because this money is getting reinvested back into the portfolio. When you get paid out a dividend, the flexibility of the dividend is fantastic. It allows you to do whatever you want with that cash. You can pull it to the side, you can use it to pay other bills, you can use it to spend on exciting things like a trip. But for this strategy, the really important part is reinvesting it back into the portfolio. It allows you to buy additional shares without having to add additional funds from your day job or your bank account. So the psychology behind it makes it feel like you're buying more shares more frequently, because a lot of this stuff is done behind the scenes and you don't have to focus on actually hitting the buy button. That's one of the hardest things about investing, is deciding when to buy or sell. And by having it done automatically, we get to avoid those decisions altogether. Nowadays, we have something called DRIP, which is the dividend reinvesting plan, which is a automated process that can happen for most major brokerages. I have it set up for Charles Schwab, I have it set up for TD Ameritrade, and if you want to figure out how to set that up, because it is critical to the backbone of the strategy, just look up whatever broker you have and then put DRIP at the end of it, and most of them, I think 99% of them, will have the ability to set this up automatically. So this is the backbone of it because it allows us to add additional funds to the snowball, and the more funds we can put in early means the faster it's going to accelerate into the future. So this is critical to the dividend snowball strategy. Okay, let's go to part 3, is how we pick stocks. I'm going to use my rules. They can be different for whatever you're looking for. This is kind of the things I'm looking for, and I have 4 rules to make it as simple as possible. Number 1 is that the stock has to have outperformed the S&P 500 since 2000. I picked 2000 because it shows a variety of time frames that the stock has been able to compare itself to the overall market, because if we can't beat the overall market, we should just buy the overall market. So this allows us to narrow our focus and really zone in on some of the best dividend stocks out there. And it really makes it so that we're focusing on the dividend aspect of it, but allows our underlying stock price to increase as well, because it doesn't make sense to focus on a 10% dividend stock if the price is going to stay exactly the same. We want a stock that's going up in price and is also paying out a dividend. And that's kind of the ways that I focus on specific stocks and cut a lot of them out, is by making sure that it's outperformed the S&P 500 since at least 2000. The second rule is it has to be at least a dividend aristocrat. When a company pays out a dividend, we are looking for them to increase their dividend payout. It's not the yield, because if the stock price goes up, that means the yield's going to drop. We're looking at the payout as a dollar amount. And so a dividend aristocrat means that the company has raised their dividend, the payout dollar amount, at least once every year for at least 25 years. And if it makes it 50 years, it becomes a dividend king. This goes along with the first rule because I want companies that have shown that they can pay out a dividend and are able to increase it over time. So it shows how the company has been able to succeed during various bull markets, bear markets, recessions, and it shows that it is a stable company that is worth investing in. Number 3 has to do with dividend yield, and it's a dividend yield below 4.5% or maybe 5%. Dividend traps are the idea of buying into a company because the dividend is so attractive, but the underlying stock is not going to go up in value. We talked about the importance of having a stock that's going up in price, in addition to having the dividend yield be attractive enough to buy into it. If the yield is too high, it means that we're too focused on the dividend, and there are some stocks out there that are paying a dividend yield that is not sustainable, and we want to avoid dividend cuts at all costs because that is a killer when it comes to the long-term success of a dividend stock if you're cutting the whole thing that you're buying it for that reason. And then number 4 has to do with we just have to reinvest our dividends. This goes along with the dividend snowball strategy, and it is the backbone of everything that I'm doing on this channel. We want a dollar cost average, we want a dividend reinvest. I've already talked about that, so I'm not going to go much deeper into it, but those are my 4 rules that I've been talking about for like 2 years on this channel on how I pick winning dividend stocks out of a field of hundreds or thousands of stocks. So let's talk about my current portfolio because it is one thing to talk about my strategy, it's another thing to show you exactly what I'm doing. So I want to put that on screen right now to kind of show some of the stocks that I'm buying. I have a variety of stocks in here, but the backbone of it is going to be Apple and Microsoft and QQQ. QQQ is not a dividend stock, it's more of the growth play. The rest of these stocks in this portfolio are 100% focused on dividend reinvesting. Apple and Microsoft are not high-paying dividend stocks, but they have the track record of being so important. I've made a video talking about why Apple is the most important stock out there by like a significant portion. It is the backbone of pretty much every portfolio out there, and although the dividend is not that high, I think it should be in pretty much everyone's portfolio. But when you look at my portfolio, I'm trying to have a nice mix of stocks. I have pharmaceuticals and stuff like AbbVie, I have technology with Microsoft and Apple, I have Nike for consumer discretionary spending, I have NextEra Energy for renewables. I have a variety of stocks so that even if one sector is down and the rest of the stock market's doing well, I'm still going to succeed. And the variety of stocks allows me to constantly be adding to the portfolio on a reliable basis. If you only own one stock, that's fantastic, but you're only going to be able to have the dividends reinvested 4 times a year. By having a variety of different stocks in the portfolio, it allows me to spread out my spending over the course of the year instead of just 4 times during the year. Let's wrap up the video talking about some important things to remember. The first one is that this is going to be slow to start. It's going to be really sad to look at your portfolio for the first couple weeks and notice that, man, I'm only going to be getting, $25 of dividends this year. That's okay, we are investing for the long term. If you want to see how your portfolio is going to look in the future, put in a dividend reinvesting calculator to show you how it'll build over time, and that'll make you more likely to stick with it for the long term. Dividends are a great way to counteract inflation, which is something that we've seen right now. This graphic shows how the S&P 500's dividends have increased versus the rate of inflation. So as dividends get increased, it has been outpacing inflation for the past almost 100 years. So it's a great way to increase value while the stock price is still working its magic. The dividend is kind of cutting out the inflation, which at this point is a huge thing to focus on. It's not fun to talk about taxes, but the government's going to want some of your money, and these dividends are taxed. So depending on what type of stock it is, if it is a real estate company or an international company, it's going to be taxed like ordinary income, which is the bracket that is much higher. But if it's an ordinary income from a US-based company, it's going to be taxed at a much lower rate. Famously, Warren Buffett pays less in taxes than his secretary because most of his income is coming from dividends, whereas hers is coming from normal, job income. So this allows us to lower our tax bill, but if it's in a normal investing brokerage, you are going to have to pay taxes on it, but we are going to be keeping the money in there, so you do need to take that into account that you will have to pay taxes on it, which is one of the reasons why I keep a lot of my dividend investing into my retirement accounts, just so it kind of shelters it away from the tax burden. But taxes are always something you need to focus on. And then finally, I wanted to talk about dividend cuts. Dividend cuts are the worst thing that could happen to a dividend stock. If you're buying a dividend stock for the health of the dividend and the dividend gets cut, it's kind of a reason to be like, okay, I'm done with this. So if you have a company that is paying too high of a dividend or a dividend trap, the risk of the dividend being cut is such a huge detractor from the overall health of the company that if I think a company may cut its dividend, I'm probably going to cut my losses and get out. We've seen this recently with something like an AT&T that cut its dividend. That was something that was coming for a long time. It was paying a 7% dividend and the stock price had not done very well during that time, and it was a long time coming. So dividend cuts are the worst thing that could potentially happen to your company. And so that's why we're buying, companies with incredible track records to try to avoid that at all costs. So my name is Andy. I'm trying to build wealth just like everyone else, and I'm trying to share my experience. If you have any comments or concerns about the dividend snowball strategy, be sure to let me know down below, and let me know your experience using dividend stocks in the comment section down below. If you somehow made it this far, please hit that like and subscribe button, and I will see you in the next video. Thank you for watching.